Well, welcome everybody. Welcome to our webinar on global M&A trends in the tech space. We have a very interesting group of panelists that will share some insights on technology deals that Oaklins has done in the past months. Um, with this, I will jump to our agenda. My name is Andrei Lepiavka. I'm a partner at Oaklins ZIMMA here in Mexico City. We lead Oaklins efforts here in Mexico. And I will be providing a quick intro of what Oaklins has been doing and our global powerhouse to generate interesting roadshows to create value to clients. After that, we're going to jump with John, who's CEO of Oaklins Cavendish, and he's going to be chatting along with the founder of Soundbite Learning with some insights on that specific roadshow. After that, we will move with our third panelist, Thomas Monteiro, partner of Oaklins Olimpia, based in Brazil, where he will show also our global reach on that specific transaction. And towards the end, we're going to finalize with Joanna Stone, who's a partner of Oaklins DeSilva+Phillips, based in New York City, where she will guide us on some of the trends that she has been seeing with investors around the world in M&A deals in the tech space. So pretty much this is the agenda that we would like to cover in the next 45 minutes, which is going to be pretty quick. And I hope you like it and learn from these very smart individuals. So before we move on, I just would like to share that on the top side of your screen or lower side, I don't know where your menu bar is, you'll see that Q&A button where you can post questions. We will go through those questions towards the end of the webinar. And please feel free to share any doubts or questions that you would like them to be answered towards the end. And with this quick intro of our agenda, I'll move on with what Oaklins is. Some of you know us, some of you don't. We are a global M&A advisory, debt and equity raising, along with other corporate finance services. We are more than 800 professionals in 40 countries, and we have 55 offices around the world. What this allows us is to help our clients get and reach other strategic and financial sponsors around the world in order to maximize the terms that can be reached, whether it's a buy-side mandate or is the sell side of a company, or you're trying to raise capital for the growth of the business. In the last 5 years, we've closed more than 1,900 deals. And something that is very interesting is that more than 50% of our deals are cross-border, meaning that we are very good at generating value with those foreign investors that are willing to pay a premium for a business in a certain region. We close in between 350 and 500 deals a year, and we are very active along the different offices from Oaklins. Just in the technology space, we've closed more than 300 deals in the past 5 years, 41% of them cross-border. Regarding the geographic location of these deals, the vast majority comes from Europe, Middle East, and North Africa, and also the Americas. And on the other side, the majority of the deals that we work on are M&A sell sides and then M&A buy sides. We believe we are an exceptional powerhouse to generate solid roadshows. That's the idea, that's the value that we bring to the table. our objective is to reach that company anywhere in the world that can generate as much synergies with your company and that can provide more value towards the growth of the strategy that you are pursuing. Just in the tech sector, we do in between 50 to 80 deals. So we have very fresh contacts around the world. You're going to see this in the next panels, but it's important that you also knew that. Within Oaklins, I wanted to present also our very solid team that we have in Latin America. Arseny and myself, we lead Oaklins in Mexico. Juan Pablo Baiter and Carlos Barona lead the efforts in Colombia. Eduardo Campos and Mauricio Concha lead efforts in Peru. Dennis and Daniel lead efforts in Brazil through Forteza. Thomas and Richard lead efforts also in Brazil through Olimpia Partners. And then we have Raimundo and Agustin, which lead efforts in Chile, and Alejandro and Julian in Argentina. We have done deals among each other in the past years. We're very close. We're very open to hear you out in case you want to reach to any of our offices. And the idea is to jump into our next panelists, where I would say the meat and butter will be shared of these interesting insights. We're going to start with John Farrugia, as mentioned, the CEO of Oaklins Cavendish in the UK, along with another founder. And with that, John, how are you?
Thank you. So anyway, a little bit of background about Oaklins Cavendish, first of all, if that's okay. Oaklins Cavendish, we've been around for 35 years, doing deals, both public deals and private deals, and helping clients sell their companies, buy companies, provide debt advisory advice as well. I know what Andrei just said about 50% of our deals being cross-border. In fact, for us in the UK, it's 80% of our deals tend to be cross-border, especially within the technology landscape. It's important for us and important for our clients, both private equity in the UK and entrepreneurs as well. There are two deals I want to touch on. The first one being Sellsite, and the second one an ex-client and now a friend of mine, Anthony Coxon from Soundbite Learning, has joined us to really talk about his experience of working with Cavendish in selling his business a few years ago. I picked Sellsite first of all because that was a deal in CRM solutions, doing 7 million, 8 million ARR at the time. The entrepreneur had very high pricing expectation. At the time, he didn't understand what an advisor could bring to the table. We went out to market. The acquirer, Sugar CRM, very, very large US business backed by Axel KKR. We went in through Sugar CRM as well as Axel KKR. The value we brought to the table there, as in the document says, they originally came in at a low ARR multiple at 4 times, 4.5 times, and we spent a few months driving the price up to make sure we got to the right price for the client. In the end, that deal was structured. It was helpful and unhelpful that one of the major shareholders in that business was a billionaire himself. So pricing, he didn't need to sell. So it forced us to really drive the price up to satisfy both the original founders as well as the major shareholders. The one I really want to move on to, and I'm joined by Anthony, is a business that we worked on a few years ago. And I thought it'd be helpful for the people on the call to really hear firsthand about, a client's experience with working with Oaklins Cavendish, as well as, an advisor in general. So Anthony, on that case, could I just start off? Could you just give a bit of background about the company you founded and a bit about yourself?
Hi, John, and hi, everybody. Good afternoon. GCSE Pod, which was the trading name of Soundbite, came about because my business partner was looking for a solution to help his son. He and I sort of got together, and this was back in 2006. And if you can just sort of recall back the type of device that you had in your hand in 2006, it was probably a BlackBerry or a push button phone. We wanted to make something that was an audiovisual product for kids to appeal to different ways that they could learn. And very quickly, we started to put together a product that was going to work for kids. Now, many kids at that time didn't have devices in their hand much as they have today. And so really, we had a bit of an uphill battle where a lot of devices that kids got were hand-me-downs from parents and so forth. I guess a lot of the innovation and the success was sort of standing on the shoulders of giants, and that giant being Steve Jobs. We used GarageBand in the beginning to help us with recording and various things like that. Our initial market was B2C, but we soon realized that the B2C journey was not one that was affordable. And so I'd had previous experience in the B2B market, and so we followed that model. So founded 2006, did a small raise in 2007-8, got the initial money in, rights issue 2009, launched B2B, sorry, in 2010, and we didn't look back. We grew through the schools market, and this was an audiovisual product covering curriculum content initially, and then we grew into having assessment side in there, and then tracking and monitoring. So the product grew into something that was way bigger than we initially thought.
And when did you think about exiting? Was it based on inbound parties coming to you, or was it something else?
So it was always set out as an exit business, but as we became more successful, we started to think, actually we need to do something about this. Other investors, so we bought out many of our, we'd had I think 7 investors in the beginning. We bought out sort of 4 of them, leaving just 3, and the other main shareholder had incentivized us a few years prior to our exit, quite significantly actually, in order to get an exit. The thing that was pivotal on this was actually COVID. So if you think back to COVID, online learning was huge, and we capitalized on that significantly. And I think it was the early months of COVID that we then thought we need to pull forward our exit plans by, I think it was by a couple of years, and that's exactly what we did. So it was around that time that we started to see some exceptional growth, and we thought, okay, we need to strike now when the iron's hot.
And how did you decide which advisors to choose? And is there anything you would have done differently?
I think during the course of business over many years, there was sort of several advisors who courted us in the sector. Now, these were advisors who were mainly specializing in the education sector. And that was very flattering, of course. But one of the things that we wanted to do, and it was certainly driven by our major shareholder, he said we need to get somebody from that was, let's say, had a touch on the sector, but wasn't majoring in the sector, and that had eyes outside of the sector, because he had previous experience where a business that he'd sold or been involved with had found a sale where it didn't come from a usual source, as in from within the sector.
And how do you think Oaklins Cavendish added value to the entire process? And if you could explain that in both the prep phase as well as the process in general, the sale process.
So I think one of the things that we did from choosing to work with Cavendish, and I will say I'm very glad we did, but one of the things that it helped us to do was to, if you like, present the business in a way that that was the right way. So the process of going through and building out the IM, for example, the questions that are asked are really significant in making us think about the best way to present the business. And if we'd gone and done that by ourselves, we would have never followed that process. And so for us, going through that discipline, where it was the management team that were involved, there was 5 of us involved, and at that point nobody else knew what was going on. and going through the discipline, I would say, of that significantly helped us to uncover certain areas of the business that we were then able to, or Cavendish was then able to subsequently help us optimize. And that then came through in the sale, so in the final sale number.
And do you think that helped in, you know, maximizing and the work that was put in by the advisor in terms of maximizing the value of the business on exit?
I think there's sort of two aspects to that. You've got the core business, and the core business was the recurring revenue subscription model that was to schools. And Cavendish then helped us to understand where some of the other value was in the business. Now, whether that was additional product that we had created but not surfaced, or additional markets that we'd put a toe into, again, that we'd established that there was demand, but that we'd really not leveraged it. And so those two areas, in the end, really helped the final number to be in a different place to where we'd originally expected. And that wouldn't have happened, I think, unless Cavendish had really helped us model those things, so the product and the market side of things, in addition to our core revenue and business.
And my final question, given that there's a lot of entrepreneurs on this webinar this afternoon, is really, if you were to start another business again and look to exit again, is there anything you would do differently next time round in relation to choosing an advisor? So
in a funny sort of way, there is, and I have started another business with my old business partner, as it happens. And one of the things that I said is that I want to get an advisor involved fairly early on to help us shape our business model, to help us shape our finances and accounts in a way that is going to be make it easier for them to be presented at the time. And this is another exit business at a time that we come to sell. So all I would say to people who are thinking about it is, if you are and you found an agent, or you think you're finding an agent that you want to work with, to get them involved sooner rather than later, because it makes life an awful lot easier when you do actually want to press the button and say, now is the time to sell, that they are familiar with your business, they're familiar with the opportunities, and also who to go with. So that's actually what we have done with this current business. And although there's a little bit of a way to go until we have proper conversations, the initial conversations have already started.
Brilliant. Well, Anthony, thank you so much for your time and speaking to the entrepreneurs on this call. Thank you.
It's a pleasure, John. Thank you very much.
Okay, Andrei, over to you.
Anthony, John, thank you very much for those insights. And our last panelist, Thomas, is going to be sharing us with an interesting transaction. Hey, Thomas.
Hi, Andrei. Good afternoon. Just a quick introduction. So I'm Thomas Monteiro. I'm a partner here at Oaklins Olimpia Partners. I'm based in São Paulo, Brazil, covering the region for more than 20 years. Olimpia Partners is a 15-year-old M&A and capital markets boutique, sector agnostic, and like most of our Oaklins members, we tend to focus on sell-side transactions, roughly 7% of our assignments, and obviously some also capital raising deals. I want to talk briefly about some of the trends we're seeing here in Latin America. I think the advantage of covering the region for the past 20 years, we have seen waves of interest for the region on and off. Obviously, LATAM is a unstable region compared to most of the other countries, but more recently, we're seeing increasing appetite for the region. I guess the key trends, basically, obviously, LATAM is a very sizable market, more than 660 million people in the region, an aggregate GDP of $6 trillion. So obviously, companies that have the aspirations of becoming global provider of solutions, and obviously a lot of multinationals here in the region. So LATAM has been a critical region for them to enter. In general, here the population is very tech savvy, early adopters of technology, very connected, for example, to social networks, something that it's interesting here in the region. So new solutions is being adopted, and the population is very pushing it forward. For example, I think we have some interesting cases. Nubank's one of the largest digital, I think the largest digital bank globally. So obviously LATAM is continuing to expand its digital infrastructure, and internet penetration is increasing. So obviously additional services are being generated. I guess a smaller trend, but also important, is the nearshoring to North America. Obviously, in the past we've seen India as one of the providers of, mainly on the IT space, providing to North American companies, and obviously LATAM, due to the time zones and obviously the cost aspect, has been a go-to geography. And obviously, as I mentioned, LATAM still has its challenges. There is a limited availability of capital. We have typically higher interest rates here in the region, which obviously brings also additional opportunity for both strategic players and financial sponsors. We wanted to highlight here some of the recent deals of new entrants coming to market. So on the strategic side, the deal we're going to talk about is basically the Enghouse acquired Navita on the SaaS space. But we saw recently, for example, Nuve, one of the prominent B2B payments player, which was recently acquired by Advent. They also did their first acquisition in Brazil. So I think this shows the interest. Global Logic acquired Exacta, company based in Argentina, Colombia, Peru. So more and more strategic players are also entering. But also we're seeing financial sponsors open their radars here for the region. I guess at least ourselves from Olimpia, Oaklins here, we receive inbounds from both strategics and financial sponsors, and obviously through Oaklins, it's happening more frequently. Here, just to highlight two deals here, I guess Summit Partners, a very large US-based private equity firm with 36 billion under management. They recently did their first investment here in Brazil on a fintech company called Cellcoin. We saw another VC growth capital firm called Bond. They also invested in a company called CRM Bonus on the SaaS space. So I guess this is a very hot topic at the moment, and for sure we're going to see more deals being done here in the region. Moving on to the next slide, just to give you a quick overview about the transaction we advised, is basically was the 100% sale of Navita to Enghouse Systems. Basically, we were hired by Aurea Capital, which is a Brazilian private equity firm focused on B2B software. And they were the controlling shareholders at the time of Navita. Navita is basically a mobile, they help companies and enterprise clients to basically manage their mobile and IT expenses. So help them to map out the cost, manage their invoices, have analytics, and also some security features. So basically, it's a SaaS that these companies manage their mobile and IT, what they're expending. And Enghouse is basically a Canadian listed company on the Toronto Stock Exchange. They're roughly a 1.8 billion Canadian dollars player. They have multiple verticals on software, so they are a software aggregator, as we call it. So they look into multiple verticals, and this was their first deal here in Latin America. So I think this was very pleasant to work on this deal. And I guess similar to my colleagues, I guess one very important feature here is we spent some time preparing the company. Obviously, being a SaaS transaction, you need to have all your metrics very sharp because the investors are going to do some intense Q&A. So this was one of the very interesting and important feature that we had to deal with. Moving along here, just to basically give you on the next slide, overview about Aurea Capital. As I mentioned, a local private equity here in Brazil. Actually, it's our second assignment that they mandated us. In the past, we sold a company called Manjiki. It's basically a cloud solutions provider, which we sold to a UK-based company called Clarinet. But Aurea Capital is one of the most important private equities here, local private equities in the technology space. They have done over 40 deals. So today they have roughly 20 companies in their portfolio, mainly, as I mentioned, and software and in many different verticals. So very glad to work with them for the second time here on a very successful deal that was Navita. Moving along here, I guess one thing that we wanted to highlight is how Oaklins assisted here on this transaction. Okay, so this was a broad process. So we reached out to 118 investors, and so basically focusing on strategic players. So across all geographies of the world. So companies that were present in Brazil, and obviously companies that weren't present. And I think what was very helpful here is that Oaklins, they suggested additional 43 strategic players, so which were all from both North America, Europe, and Asia. And we ended up receiving on this process roughly at the end 5 non-binding offers, and 2 out of the 5 non-bindings came through Oaklins. So I think and the Eng House, the winner of this process, was one of the suggestions that came through Oaklins. So I guess this just is very helpful for obviously entrepreneurs and or private equities that are thinking about exiting their business, how Oaklins brings value to the table. And this is a practical case here that we had on the Navita, on Project Smart case study. And just moving on, I guess, to wrap up here, how Oaklins contributed. Obviously, the first point that I mentioned is we through our experience here, we see how Oaklins contributes to increase the reach to strategic players in all parts of the world. And obviously with the second point, which is very deep sector insights, obviously of the sector itself, of previous deals in the same sector, for example, but also very fresh knowledge of the strategic buyers, of what they are actually pursuing, if they are on, for example, M&A mode or not. We share obviously best practices, valuations, how was, for example, on similar cases throughout software or IT service or other sectors. So I think this is very helpful. And Oaklins in general we have a very middle market focused, which is, it's very good to identify potentially some middle market clients and companies that could have interest to acquire some of the assets we are conducting a sell side. And I guess my background, I used to be from a large investment bank, so there's a very important difference. Obviously, these large banks, they tend to focus on the S&P 500 to very large companies, but the coverage is not so great compared on the middle market, which we have seen. These companies are very acquisitive. They want to expand. They're backed by private equities in most cases as well. So I guess I think on this case, Oaklins have a very deep roots to identify and access these companies. So, and obviously Project Smart is a example. I guess Aurea Capital was very satisfied of Oaklins. And so this is some of the topics here I wanted to share with you guys. So
Thank
Andrei,
you, Thomas. Very interesting on how we collaborate along with the different offices around the world. And with that, we're gonna wrap up with Joanna, who's partnering Oaklins DeSilva+Phillips in New York, where she's gonna share interesting insights on how investors are looking into tech deals. Hey, Joanna.
Hi, thank you, Andrei. I'm Joanna Stone. As you mentioned, I'm a partner at Oaklins DeSilva+Phillips in New York City. Our firm started 28 years ago as a boutique investment bank that's focused solely on media and technology. And in 2016, we became part of Oaklins. I co-lead the global TMT practice for Oaklins along with Brad Adams, who you heard speak earlier. And my primary focus area is technology within SaaS companies, within the SaaS company area. I do want to mention that I was just recently in Santiago with Raimundo at Lorraine Val in Chile, presenting on some of these same topics. And our managing partner, Reed Phillips, was recently in Brazil, and we worked together on the deal in Brazil. And so we work very closely across borders. So I want to thank you. It's great to be speaking here virtually, and we look forward to more opportunities to be in person together. With that, I just want to start with the next slide by touching on a few trends across technology, TMT, M&A. And one of the things that I love about working in TMT is that it really does lead all M&A sectors. It accounts for the largest portion, 17% of all M&A, and drives a lot of other M&A. As Andrei said, I'm going to talk about the trends that we're seeing globally. I'm also going to talk about how tech companies can position themselves for the best possible outcome. So a few trends that are worth noting to start is that tech M&A has really been resilient. There's been a lot of uncertainty in the past few years. We'll show a little bit of those charts, but one of the reasons for the resilience is that strategics need to keep acquiring technology companies. The large strategics can't possibly innovate fast enough to keep up with all the changes in technology. So they're always going to have to buy some of that technology and buy some of that innovation. And although strategics stayed pretty active, there was in the past couple of years, a real sitting on the sidelines of PE firms. And we're seeing that change. We're really seeing PE firms jumping in starting the beginning of this year, a real dramatic uptick in their need to start to put some of this dry powder to work. We also continue to see growth in cross-border deals, and we've seen a real growing focus on AI, as everybody has, and also some increased regulatory scrutiny. And software accounts for the vast majority of all the tech deals that we're talking about. And so I'll also spend a lot of my time talking about the software SaaS sector, because that's where I particularly spend most of my time. So the next slide, just looking back at some of the trends, and some of you have lived through this roller coaster. If you go back to early 2021, tech valuations were at a beautiful all-time peak. And then we had this very dramatic fall off. So, in 2021, it was easy to get really nice double-digit multiples on ARR. And then that sort of fell dramatically. And with that, we saw a lot of people pausing, because you had different valuation expectations between buyer and seller. So of course, people were struggling to find a clearing price. And what has been very comforting is that we really have kind of reached level ground. The last few quarters has seen a lot of consistency. And so I think people are feeling safe to kind of jump back in, that there is still robust multiples that will be paid, and they're reliable. Next slide. So just to touch a little bit on what we're seeing globally, we talked about M&A being very active cross-border and globally, and we really are seeing significant M&A across all regions. North America still accounts for the largest volume, but Europe is a close second. And I think what's interesting is we're also seeing South America on track to have some very significant growth and activity this year. And if you look at the buyers that are the most active across the past 3 years, these are buyers that are really buying across a lot of different regions. They're really buying globally. And so it really does mean that when you think about a deal, and you've certainly heard other people talk about this in the case studies, you really have to take a global perspective on where your buyers may be and the overall opportunity. Next slide. So it's also interesting, I think, to talk about how deal activity breaks down by type of buyer. Certainly the predictability of recurring revenues that you get from SaaS businesses, the predictable cash flow, is incredibly appealing to both strategic buyers and private equity. And so this is really a snapshot of the software sector. We've seen, some of this being driven, as we mentioned before, by some current trends, such as, increase in artificial intelligence requirements across companies, and also a growth in cybersecurity SaaS offerings. And, these are hot areas that have driven a lot of M&A activity. We also, talked about the dramatic decline in PE dollars, in PE. And if you look at the PE dollars that were invested last year, that was a huge fall off from the year before, and a significant fall off from 2021. But we're really seeing that rebound. I mean, year to date, we're almost at 2023 levels. And strategics are continuing to increase. They had a nice increase last year and in dollar volume, and we expect that to be even more significant this year. So the next slide, a question that we often get from entrepreneurs is, what do buyers want? And I think the value drivers for both strategic buyers and financial buyers are prioritized differently. And then you've really heard this come up also in some of the case studies as well, and how this plays out in real situations. I think the flip side that's also been touched on is that whether what a seller wants from a buyer is sort of implied by these value drivers. But if we start with, the strategic buyers are really looking for a strategic fit. They're buying because it is either, fitting some sort of hole, some sort of gap they have, or a priority area for growth that they need to add to. And this is why sometimes you can drive really huge outsized multiples, because if a strategic buyer needs something, they can really stretch to get that. And that also plays to the revenue synergies and cost synergies. Strategic buyers, and I started my career on the buy side for my first half, so I've done this for a living. They look at a model and they figure out, what revenues can I add on? What costs can I take out? They don't want to give the company they're buying credit for those synergies, but if they want the company enough, they can. The other thing that I think is interesting to note, and this relates to what's a seller's expectation, is that the strategic buyer is not as concerned about the experienced management team typically, because they assume that management team is going to be out the door after some sort of transition period. They do think about the next level and become concerned if there's not successors that can step up, if there's a skill set they need. But it also means that, it's a very different, obviously, equation if it's a seller who wants to stay on. Financial buyers, just sort of starting at the bottom, on the other hand, need a really experienced and motivated senior leadership team to stay on and lead the company. They care a lot about the strong financial KPIs. They really want a leading player and those sort of scalable, attractive business model attributes. They also often look for a proven track record of successful M&A transactions, something that obviously is less important to a strategic buyer. It's not essential, but it's certainly a plus in many financial buyer situations that we've been in. And so if we go to the next page, one thing that's important to all sets of buyers is the key KPIs. And when we talked about multiples, we talked about the fact that there's an average multiple and what those trends are. But within that average, there is a wide range of what buyers are paying. And if we want to get our clients the highest premium and, really outsized multiple, it's very important, where possible, to have high performing KPIs. So we spend a lot of time with our clients talking about the KPIs that are most important to buyers. And, for SaaS companies, obviously, retention is incredibly important. There are the financial KPIs that matter: ARR, the growth of ARR, the gross margin. The rule of 40, I still find, is something that gets thrown out in a lot of my buyer calls. And of course, this is just adding together the ARR growth and the EBITDA margin. And so it's accounting for the fact that, some of our clients aren't profitable. And if they're growing fast enough, that's okay. Although we do find that profitability has become more important since 2021, but it can get made up for by growth. And other KPIs also balance each other out. So like revenue concentration can be very important to a buyer. But if you have a very long average contract length, that can help make up for some revenue concentration concerns that your biggest clients might leave if they're tied up for the next 4 or 5 years. It's not as big a concern. So, with our timing, I'm not going to go into detail on all of these, except to say that, it is one of the things that companies can start thinking about early. And that brings me to my last slide. And in the first panel, Anthony Hoxton mentioned about his current business and the importance of getting an advisor in early to shape the business to be prepared for sale. And this is something that we do with many of our clients. And I think the thought that I wanted to leave everyone on this webinar with is that there are key steps that an entrepreneur can take and should take early that will help enhance the value whenever you're ready to sell. So, the first step is just the evaluation. It's really understanding the slide we talked about before, what are the key value drivers, reviewing and analyzing your financials, understanding what your current valuation is and what's that gap between the valuation where you are now and where you want to get to, and how do you get there? And then you prioritize. If you've got some KPIs you need to fix, you prioritize fixing those. You spend some time, understanding what would really have the most impact on increasing enterprise value and getting your financials in order. I find it's very important that, companies that are earlier stage make sure to have the discipline of monitoring progress against whatever goals they've set around increasing their enterprise value and their KPIs. We suggest quarterly review sessions. It's also really important to seek guidance on key decisions. First of all, partnerships are a great way to sometimes find your next buyer. We've had some incredibly successful sales because they start out as a partnership and the partner realizes they must have you. But it's also really important not to sign something with a partner that makes it really hard for someone else to buy you. And we've seen that as well. And it can have a really negative impact on valuation. So it's important to get those types of decisions right and avoid mistakes. And most importantly, just you want to have everything in order, because good companies usually get some really exciting incoming interest at some point, and you want to be ready for it. And so, it's not that when you get that company calling and saying, we'd really like to buy you, that's not the time to figure out, are your financials in shape to send to anybody? That's not the time to start calculating your KPIs. So having all these things ready means that you're prepared when buyers come knocking at your door. And the main thing is to sell that you should be able to sell in your own terms. So doing all this will really position you in a place to achieve the highest possible valuation and the highest possible outcome across all categories, because you've really thought first about how to prepare for that exit. And so with that, I think we're probably a little over time overall. So I'm going to hand it back to Andrei. I know he wanted to leave some time at the end for questions, so I tried to go quickly, Andrei.
No, it's very interesting, Joanna, and excellent insights on what you've seen in the market. I will then switch to a couple of Q&As that we have here. And the first one goes to John and Anthony. What are you seeing in the UK from a private equity firms looking to invest in South America? What are the recent trends that you've been seeing, John?
What we've seen from the larger UK funds is that they're looking for alpha. Many of the PE houses are buying the platform deals and paying up for it, and they're looking for ways to really kind of expand more globally to enable their next PE house to come along and buy them out in 3-4 years' time. We've seen over the last 10 years people push into Europe, but we're now seeing people and asking us to look for opportunities in South America as well. Some of it is to do with the nearshoring, offshoring that we just kind of discussed earlier, and some of it is expansion into new products and services. So again, given the distance between UK and kind of South America, it's going to be kind of less relevant than, say, PE houses in North America, but we are seeing increased demand.
Thank you, John. We have another question for Brad. Brad, can you discuss any differences in your approach to strategic buyers versus financial sponsors in the ASD transaction that you mentioned?
Yeah, sure. I'll highlight it a little bit. As I indicated, the process was a bit more heavily weighted towards private equity, given the interest of the CEO and former founder to essentially roll equity and retain some ownership position. But we had sponsors as well that wanted to maximize value, so we certainly test the waters with some of the logical strategics. And I think some of the things that were important and some of the differences, I suppose, is on the strategic front. First off, getting to them early. The sponsors are built to do transactions. They move fast and they play within an advisor's process timelines. Strategics sometimes don't, and so there's a lot more consensus building in committees they have to go through. So getting them information in advance to help them with that process management is certainly one of the key differences between the two buyer groups. I think secondly is positioning. I talked about positioning in general, and what we find here at TM, whenever we're approaching strategics, we spend a lot of time curating the strategic rationale for each buyer, or at least each buyer camp. It's not a send an email with a teaser to Brad, BCC 40 corporate development folks, right? It's a specific message, a conversation that's targeted and tailored to each buyer, because the value prop for each buyer is going to be different for our client. And that's important to understand that. And that comes with industry expertise, knowing what buyers want and knowing how your client fits in with their objectives. Certainly cautious with information on the strategic side. In some cases, perhaps blinding information in and around customers, partners, and employees. We always have NDAs in all of our process, but there's a practical element as well. It is a bit different than dealing with sponsors. Synergies. Joanna mentioned this in her presentation. Outlining synergies, both cost and, more importantly, cross-selling synergies again for each buyer, and tailoring a message to help the buyer see the fit and the value based on perceived synergies. I think one last difference is, I mentioned ASD, and we talked a lot about the growth strategy, organic and inorganic. For a strategic buyer, the organic growth strategy is a lot more important. If you're going to do other acquisitions, they'll do that. Whereas with a private equity buyer, they certainly want to understand the organic growth drivers, but they want to understand there's accelerated growth potential through strategic acquisitions. So we'll spend a lot more time on the private equity buyers talking about acquisition roadmaps and how the company's going to accelerate growth through M&A.
Excellent, Brad. Thank you very much. We have another question. Which says, how much of a problem is dealing with different cultures involved across countries? I don't know, Thomas, in your last deal that it was across border, if you were to encounter this type of differences in cultures.
Yes, I guess that's a very interesting question, because at least here from Brazil, we deal with multiple countries, and obviously from North America, Europe, and Asia, etc. And obviously there are many differences out of obviously the culture in general, but how do they approach M&A? So obviously in Latin America, right, people tend to have, for example, more of the friendly approach, etc. And obviously when you talk to a US private equity, they're much more straightforward and sometimes tend to sound, for example, even blunt or aggressive. So something that we try to at least prepare our clients when you're dealing with the strategics and obviously financial sponsors from different places of the globe, to understand the difference and especially if they're going to be partners, right? If you're selling the business for 100%, obviously the main variable that matters is price. But if you're bringing a partner, which you have a shareholders agreement in place, you're going to need to discuss problems, right? They will always arise. But it's very important to obviously know who you're dealing with, understand how they can approach, understand, probably talk to previous companies they bought or founders of these companies. So, but it happens.
Yeah, it's interesting. We've been in other deals where there's different sorts of examples and mechanisms to maintain the culture along after the acquisition. And along or tagging that to this question, Joanna, in your perspective, how difficult is to keep the management of the acquired company? In your case, what type of mechanisms have you implemented, or what have you seen in your latest transactions?
I mean, certainly, I think that when the management team is very critical, companies, strategics, well, let's first start with strategics. Strategics will often want to do some sort of earnout or sometimes an earnout plus stock incentive program to really keep the management team incented. I think, you know, my job as a banker is to make sure my clients have ultimate flexibility. But I also think that sometimes these can be very aligned because they can just sweeten the pot for everybody if the seller feels really empowered to help drive increased growth and rewarded for that. And very often our companies are hitting an inflection point where they realize without some sort of outside capital or outside resources, they're not going to meet the potential that they see in the market. And so having a buyer offer that potential and then offer them a piece of that is a very exciting way to both, you know, monetize this company that they've built from the ground up, but also be able to have some additional incentive. And then, you know, as the expression goes, the second bite of the apple, PEs offer that best by putting some rollover into the deal that, you know, keeps the parties aligned and really can end up being an even bigger part of the overall consideration if your PE firm invests and helps you grow the company significantly, and so that the next time you go to sell, your 30% is worth a lot more than your original 70%, as an example. So that can also be an exciting way to keep the seller very engaged and motivated for a long time post the initial transaction.
Interesting. Thanks, Joanna. I think with this, we finish this webinar. I want to thank our outstanding panelists with very interesting insights from UK, Brazil, and the US. And I also want to thank attendees. I hope this webinar was interesting to you and you were able to take valuable insights for your businesses. We will stay in contact with all of you for our next TMT webinar. And thank you all for attending. So this will be it. And thanks so much to everyone. Goodbye.